Hey everyone, Retire on Dividends here. Back to make another video of how to retire on. And the next up by popular demand is how to retire on CONY. So what the heck is CONY? Well, to keep it short and simple, it's basically trading options on Coinbase. And Coinbase is a crypto platform. It's essentially the crypto platform in the United States, at least. It's been around for quite some time, and it is, I'll call it the monopoly of the crypto space. And crypto has been growing and growing and growing. So coin is doing better and better and better. Now, CONY is a yield max ETF. What they do is, again, they basically sell calls on coin. And since coin is very volatile, it makes a lot of money through the premium, and they take that premium and they reward that to the shareholders, and they pay it via distribution. So essentially, it's basically an options play that just pays out, a lot of money. If you look at the distribution rate on the website, as of today, it's showing 93.22%, but that's simply based off of the latest distribution, multiply it times 12, and then divide it by the current price of the individual of the ETF. Obviously, here's the distributions, which we'll get into in a second on the spreadsheet. And this fund had launched August 14th, 2023. So we almost have one full year, which is good. Again, when I make these videos, I like to have at least one full year, but sometimes they just don't have that yet. But since you guys want it, I'm not going to wait. And here it is. All right, let's get to the spreadsheet. All right, so here's the list of who I've done so far. I did Roundhill, which is QDTE, XDTE, and then I did YMAX, which was my biggest hit, and then I did Misty, QQQI, and FEPI. So next up is CONY, but if you guys have suggestions for anyone else, or in any particular order, I will do that. If not, I'll just kind of go in order of what I have here, which would put YMAG as next up in line. Yeah, so just put it in the comments below the fund you'd want me to cover next. Doesn't have to be on that list, by the way, but it has to be a high yield fund. All right, so as usual, I typically just update this spreadsheet. Obviously, the ticker is CONY for CONY. They launched August 14th, and the price at that time was $19.77. Today's price, and when I say today, that's as of the last close from when I made this video, which was Friday, June 14th, and that's $21.86. So capital appreciation from inception it's up $2.09 or 10.57%. Distributions, if we go right here, if you plug in all the distributions from inception, you can see they add up to be $15.74. Also, one thing I always consider is the yield, and this is the yield as of the declaration date. So if you take how much they declared on declaration date and you times it by 12 divided by the current price at that very time, you see the yield. So then I use all those yields and then I average that up to the average yield, which in this example, it's 93%. So going back to the sheet, the distributions, as mentioned, paid 15.74%, again, which is pretty damn good. And then, so total return, if you take capital appreciation plus distributions, that's $17.83 per share or 90.2%. Again, this is calculation based from inception. Average yield, I have that plugged in here. That came to 93%, as mentioned. And then again, capital appreciation from up here, 10.57%. So it's at this point where I kind of make, okay, a hypothetical. Someone did comment, can you put some more realistic numbers? And he mentioned $1,000 investment. He didn't mention how old he was. So I'm just going to plug in, let's just say you're 30 years old and you have a starting investment of $1,000. CONY, again, for now, I'm just going to use the numbers based on prior performance. And let me just tell you, future performance will not replicate prior historical performance, especially on CONY. I mean, if it would, I'd put all my money into it. But, CONY's just been on a tear. To repeat what you're about to see is almost impossible. But anyway, let's just use it and then we'll update some numbers after that. Starting yield 94%. So starting investment, if you put $1,000 in, you'll be already making $78 a month. So that's good. So again, how do you calculate that? You take B12, which is the starting investment of 1,000. You multiply that by 94%, which is starting yield, and then you divide that by 12 months. Okay, so here's the real statistics here. So we said $1,000 is the starting point, and let's say you could put in $6,000 a year, which is $500 monthly. Okay, that's good. All right, and then if you look at the next row 17, they so far have a capital appreciation of 10.57%. So if you subtract out the annual expense ratio of 0.99% and then divide that by 12, you get a capital gain per month of 0.8%. Is that realistic? Of course, probably not. But again, we're just using historical data for now. Tax rate, I always use 25%, but some people, they always say, all right, what if it's in a retirement account? I mean, what if this, what if that? That's why I share these spreadsheets. You guys can plug in whatever you choose. All right, so for those of you new to this type of video, this is my calculation tab that basically does all the work for me. I don't really have to do much except plug in the numbers in the beginning and get the distribution numbers. So if we scroll to the top, our starting capital is $1,000, and then we contribute $500. So if we take the 1,000 and then we add, again, these are monthly, so I'm going month by month, January, February, March, etc. So 1,000 capital plus 500 plus monthly income of $78.19 plus capital appreciation, subtracting taxes, column M, you get the next month. You start at 1566.33 and so on and so forth. And as you go down the line, you can see using these types of numbers, the jump is just drastic. Like you hit $1,000 a month in year 2, right? You're 30 years old, you start, you're 31, you're making $1,000 a month, and your starting investment was $1,000 and you only put in $500 a month. So you can see where this is headed. So get ready for some dangerous numbers here. All right, first we will start off at year 1. We talked about you would be making an annual income $938 or a monthly income of $78. After year 5, you'd be making $169,000 or a monthly income of $14,000. At year 10, this is where it gets a little ridiculous, $8.4 million in annualized income or a monthly income of $704,000. I shouldn't continue, but just to see how beyond ridiculous this is for clearly entertainment. Let's continue. Year 15, okay. I can't even say this. $405 million a year, okay? And that's $33 million a month. Okay, sure. And then year 20, I can't. But guys, that's why, future performance there's no way. It's not going to repeat it. So what do we have to do? We have to plug in some realistic numbers. So where do we do that? Well, we can do that on, let's say, capital appreciation. So one thing I always do is, let's just assume a capital flat. So let's get rid of any capital appreciation. Most people would say it's going to go down in time, but I don't know. Maybe, maybe not. But let's just say capital appreciation is 0. And then we have the average yield. So what adjustment should we make to that? We can make it probably 1/3, 2/3. No, we'll make it. Yeah, we'll keep 2/3. So say 66%. So that would make it a 61% yield with no capital appreciation, okay? And let's just see what that looks like. All right, so year 5, that would be $44,000 annualized, $3,600 a month. Again, this is what $1,000 investment and $500 a month, and you're 30 years old. Well, the age, I guess, doesn't matter, but you guys can think what you want here. Year 10, which would put them at 40 years old, $479,000 annualized income. That's a monthly income of $39,000. Year 15, again, it's already getting ridiculous again, $4.5 million in annualized income, or $377,000 a month. And then year 20, we're looking at $42 million annualized income, or $3.5 million a month. Again, these numbers are still ridiculous, just with capital flat and a 61% annualized yield. So, is this possible? Like, is coin always going to be this volatile? Maybe not, but that's why we cut the yield in half, right? I mean, how much more do you want to shrink this, right? Do you want to make it 50%? Is the IV going to be cut in half? I mean, then capital appreciation, what do you want to do here? I mean, right? Let's see what it was. What was it? 10%. So we subtract what? 12%, and then you're happy. Is that better? All right. So capital appreciation a year, negative 1.43%, and then average yield of 46.92%. What do the numbers look like then? Well, let's scroll to the last year, year 20. You'd still be up $350,000 a year, $80,000 a month. So again, you could retire in 20 years in that example. But again, that's if you assume, a much worse scenario than what you're dealing with today. But again, I don't know, you don't know, nobody knows what the future of CONY is. But keep in mind, when you invest in these funds, you're basically retiring on premium, right? You're retiring on implied volatility. All you have to rely on is the company staying in business, the company not tanking, because if those, obviously if the company goes out of business, you're screwed, right? So these funds, that's a big risk that you take investing in any company. And then obviously there's the risk of the volatility going down overall in the market, or the volatility going down in this fund. Like if coin becomes a more stable company, the volatility could go down, which would not make the options premium as attractive. So that's also a risk with this one. And since it's crypto, of course, it's the risk of the government, getting involved and shutting something down and ruining it. So that's a risk as well. So there's all different types of risk, and you guys know that, you're grown-ups, but I just wanted to kind of explain that briefly. CONY has been on an absolute tear, so to repeat what it's basically been doing would be, again, impossible, especially 10, 15, 20 years out. But again, the point of this video is to show the power of compounding, the power of these funds. These funds are not going anywhere, in my opinion. I mean, as long as they make money, as long as these fund managers are producing their expense ratio of 0.99%, why would they go anywhere? And if they do, another one will come out, because you see more and more keep coming out, which means more and more competition. And eventually there's going to be just that sweet spot. And to me, I'm happy. My sweet spot is 40% annualized yield. I know that's low to the high yield world, but it's extremely unrealistic to the outside world as well. So I don't know, take it for what it's worth. I wanted to get this video out, how to retire on CONY. Again, when you say how to retire on an individual, yield max ETF that relies on an individual underlying, obviously, much more risky, but it is fun to watch. So keep in mind, this video is just for fun and entertainment, but I will share the spreadsheet and you guys can play around with it. I'll put it in the spreadsheets channel on the Discord, so you guys can do whatever you want with it. Also, I'm not a financial advisor. This is not financial advice. So again, do your own research and choose the fund that works for you. Everyone's different, all right? So yeah, like I said, leave down in the comments below the next fund you would like me to cover. If I do not get enough feedback, I'll just go in order. But yeah, I'll keep making this series because I think it's it seems to be a big hit, and until it's not, I'll stop. But let me know if you guys did enjoy this video, either via comment or hit the like button. It does help a lot. As you can tell, you hear the birds. I'm doing this video in the morning, and I'm also talking a little lower than usual because there's a sleepover in the house, and I don't want to wake anyone up. Although they're probably up, who the hell knows? Anyway, guys, I'm out of here. Thank you for watching, and have a great day. Later.